What's up, everybody? Jesse Park, a U.S. economist that leads a team at Bank of America, warns that the U.S. is in for a housing recession similar to the 1980s rather than 2008. Looking back at previous housing recessions, we think the 1980s are a better analogy for today's markets than the 2008 housing crash, they wrote in a Thursday note. While the housing crisis of 2008, which was largely caused by the subprime mortgage crisis, is compared to what's happening now by many housing market pessimists, Bank of America's experts are debating that what we're seeing today is actually quite different. Regardless, Park and his team think we are in for a lot more pain in our future. So today we're going to take a look at an article in Fortune by Will Daniels titled, "Buckle Up for More Turbulence in the Housing Market. B of A says it's a housing recession 1980 style," to see what they're saying. And like usual, I'll chime in with my opinion as well. So let's dive right in. Even with the Fed Reserve hiking interest rates to fight inflation, pushing mortgage rates to a 23-year high this month, many housing economists believe that home prices will not fall like they did during the 2008 housing crash, which instigated the global financial crisis. Park and his team noted that we don't have an excessive amount of housing inventory today like we did back in 2008, and many homeowners have significant equity in their homes because of the rising home prices. Daniel writes that it took until June of 2022 for national home prices to peak, even as mortgage rates soared and purchase applications plummeted. And while prices fell more than 5% from their peak, by January this year, they returned to a record high in July. Household mortgage debt represented roughly 65% of U.S. consumers' disposable income in the second quarter, compared to 100% before the global financial crisis. And the ratio of Americans' mortgage debt to their real estate assets, also called loan to value, was just 27% in the second quarter, compared to over 40% in 2008 and roughly 50% in 2010, Bank of America's data shows. And as far as lenders, there are much tighter restrictions today than there were back in the early 2000s housing bubble, which, let's just say it, there were basically none, to avoid another housing crash by homeowners not being able to pay their mortgage payments because they were not really qualified to get that loan to begin with. We reiterate that we do not expect another housing crash like 2008, Park and his team concluded after presenting the evidence. But they do see more turbulence in our future. According to Bank of America, today's housing market looks a lot more like the early 1980s than it does 2008. Back then, just like today, home prices have boomed for years before Fed officials were ultimately forced to hike interest rates aggressively to fight inflation. So let's go over the numbers from the 1980s, since a lot of us weren't buying houses back then. This is taken from Daniel's article. The rise in the consumer price index peaked at around 14% in 1980. Before then, Fed Chair Paul Volcker's hawkish policies sent mortgage rates to 18% in a year's time, cooling inflation but sparking a recession. This caused a serious downturn in the housing market, in which home sales and building levels cratered. However, national home prices actually remained stable. At the start of Volcker's term as Fed chair in August of 1979, the median U.S. home sales price was $64,700. Don't we wish we had those prices now? And even after a near doubling of mortgage rates, that figure rose to $69,400 by the second quarter of 1981. Over the past 18 months, Fed Chair Jerome Powell has been following a very similar game plan to Volcker's, raising interest rates aggressively to fight inflation. The average 30-year fixed mortgage rate, which is the most common type of loan in the United States, has soared from 3.8% in March of 2022 to over 7.5% today as a result. This in turn has slowed down mortgage purchase applications, and home sales have plummeted, just like they did back in the 1980s. But home prices, echoing the dynamic back then, have remained high. Park believes that one of the key reasons for the resilience of the housing market in both of these periods has to do with demographics. Noticeably, demographics were favorable back then, with baby boomers having entered the prime home buying age. Park and his team wrote Thursday, arguing millennials are in a similar position today. Some sales activity should be supported by millennials reaching the prime home buying age, and single-family building permits have steadily held up. This can help the housing market retain some of its momentum without falling apart. Bank of America economists believe that the low inventory of existing homes for sale, combined with solid home sales to millennials, could help put a floor beneath home prices. But that doesn't mean there won't be some near-term pain due to high mortgage interest rates. With rates likely staying higher for longer, we are cautious of potential turbulence ahead, the group warns. Bank of America has previously forecast 0% home price growth and falling home sales for the full year 2023, but it didn't offer a new prediction in its latest note. Eventually, as inflation fades and the Fed starts to cut interest rates, housing affordability will improve. At that stage, we should see a more stable housing market, Park and his team wrote. Until then, hang tight. It may be a bumpy ride. So while Park thinks that millennials will help home prices stay high by still buying now, Redfin CEO Glenn Kelman thinks that millennials have actually stopped buying homes. 1 in 5 millennials believe they will never own a home. And if you don't have that conviction that you're going to get your piece, it's really hard to invest in the long term. I think we have to come together as a society, build more houses, and figure out a way that the next generation is going to be able to buy into our society. Kelman agrees with Park that we are in for more pain and warns home buyers that the relief from the rock bottom economic conditions remains uncertain. You'll have to ask the Fed when the market's going to get better, because it seems very unlikely that interest rates will ease by the end of this year. So the only real question is whether we're going to catch a break entering the home buying season of 2024. But I think most people have written off the 2023 home buying season, he said earlier this week. And it's important to remember real estate is very localized. In my experience, it's not so much about the age of the buyers and sellers that I'm seeing today, but rather the particular situation they're in that's motivating them. Whether it's a new baby and they need to have a bigger house, or possibly downsizing and leaving the area, the buyers and sellers that I'm seeing have a very specific reason for buying or selling in this market. And the houses are either selling in multiple offers, even with these high interest rates, or are sitting on the market week after week with price reductions. It's a mixed market, and in my opinion, cannot be categorized by simple demographics. According to the latest Realtor.com housing trends report, 10.1% fewer sellers listed their homes in September compared to the same month a year ago. The total number of homes for sale, including both new and old listings on the market, is also down annually by 4.4%. The inventory of existing homes continued to be limited this past month, says Realtor.com chief economist Danielle Hale in her analysis. Just to compare, housing inventory is down 45.4% compared to pre-pandemic levels from 2017 to 2019. In other words, 4 years ago, there were nearly twice as many homes for sale as there are today. That's insane to think about, and in my opinion, the main reason home prices are remaining high. In Redfin's latest housing market update, 31.2% of homes sold above their list price, and 6.6% of homes for sale each week had a price drop. That's the highest share since November of 2022. The median sale price is up 2.9% year over year, and the median asking price is up 4.6% year over year. These are national numbers. We have a serious affordability crisis on our hands. A trifecta of rising home prices, record high mortgage rates, and limited inventory. But what do you guys think? What are you seeing where you live? If you missed last week's video where we gave 5 experts' opinions on the future of home prices, whether they will soar or plunge, definitely check that out next. I think you may be surprised by what they say. Thanks for watching. I do appreciate it. Bye!